it's important that we address the global issue. The Fed statement appeared to indicate that the Fed is in a slightly dovish mood since the assessment of the US economy was downgraded from what it called moderate last time to now modest recovery, and giving the hope for the markets that therefore the tapering could be postponed just a bit. Arnab Das of Roubini Global Economics joins us on this issue. Arnab, thanks a lot. What would your reading be that the Fed sounded a little more dovish, and therefore when would you put your timetable of tapering to start?
Well, I think the first thing to say is, all this focus on modest versus moderate is probably well placed and understandable, but there's not a enormous amount of difference between the two. It seems to me the main issue is that although the second quarter growth number was somewhat better than many people had expected, the first quarter growth number was revised down. That gives rise to a kind of consensus opinion that the economy is improving over time, despite the fiscal drag that is kicking in this year. I think there's something in that, but I wouldn't want to make too much of it because the level of GDP is essentially in line with the consensus. There's just been some shifting around of the time path of the growth rate. And then in addition to that, inflation, of course, remains very well behaved, maybe too well behaved. And this is, of course, part of the reason for the Fed's dovishness. And then the final point I'd make is that the dovishness here at the end of July stands in a bit of contrast to the prospect of tapering and the alleged kind of, or as it's termed, the miscommunication that the Fed had undertaken in the last few months about tapering, which had sent the markets into a tizzy of kind of fear of tightening. So when you sift all of these things through and think, what's really going on, basically the growth forecast, the growth trajectory, the consensus view, it's more or less converging to roughly, I would say, where we are, which is, there's a continued recovery, which is positive. It's good enough. It's not great. It's not enough to tighten. It may still be enough to start tapering, and the door for tapering is still very much open in the fourth quarter. Sure. So, trying to time these things perfectly, of course, is quite difficult, but it's quite likely that there will be a tapering, probably late in this year. So when that comes, the good news is that there won't be tightening for a very long time, right? The actual tightening will probably not take place until 2015. And I think the thing to emphasize here is that the Fed is not going to change the direction, as opposed to the pace, of monetary policy, the trajectory of monetary policy, until financial portfolios can withstand the hit from so doing, right? Because, of course, the recovery is being engineered in substantial measure through an increase in asset values and wealth effects that trickle down to income. So if those wealth effects are not assured for long enough, then income is going to suffer, output's going to suffer, consumption's going to suffer, and it's going to be a setback to the recovery. And I think that's really what's going on here, sifting through the noise of what the Fed is saying and what the data are indicating.
Sure. Arnab, hi, morning. In the morning we were talking to CLSA economist, and he said that what the Fed is actually doing is making a distinction between tapering and tightening, and in that sense, it is still on course maybe for a September tapering. Do you see that there's still a possibility that they may start tapering as early as September and maybe not wait till the last quarter of this year?
Yeah. I guess yes. September, October is probably the right time frame. I guess I was using some shorthand to say Q4. It could be the end of this quarter or early to mid next quarter. That's going to be entirely data dependent. On this fine distinction between tapering and tightening, I think there's quite a lot in that. Tapering, of course, is a slowdown in the pace of easing. There will be several steps in this exit strategy. So the first is to judge when and how much and how to quote-unquote taper, which is slow down the pace of asset purchases. Next will come probably a stop in asset purchases, and then there'll be a tightening. And that tightening could come through asset sales or through runoffs of assets so that the balance sheet shrinks, the Fed's balance sheet shrinks so that the quantity of money goes down, and or it could take place through an increase in the price of money, right, through a hike in the federal funds rate. Which and when and what combination of these come through, I think that's going to be determined by the data over the course of the next, not just weeks and months, but the next year, right, next several quarters. So we, like I said, we have a long series of steps and many different kinds of steps in this eventual exit. Okay. I think stepping back from that, the other thing that has to be said is that we are talking here about an exit, however gradual it may be, from easing, whereas every other major central bank is still in easing mode.
So, Arnab, how would smart money managers like you all, play the asset market at this juncture? Would you still continue to buy U.S. assets simply because any tapering is an indication that the Fed itself is acknowledging a recovery and therefore it is buy U.S. markets? Will there be a flow of funds away from emerging markets to U.S. markets? What would be your top three asset classes and what would be your sells, more importantly?
Well, I think a lot of this has already happened, we've been of the view that the U.S. was better placed than many other of the major markets and the emerging markets, and I think that that continues to be the case and will continue to be the case. However, I would say that unlike the regime of the period of no tapering talk and increasing accumulation of data about U.S. recovery, this period is going to be a much more volatile period, right? The period before, let's say, May 22nd, right, so kind of the first 5 months of 2013, was a very good time when money was increasing, the size of the money stock was increasing, the economy was recovering, and the U.S. economy was doing, it looked significantly better relative to expectations, whereas China and other emerging market countries, including India and most of the others, and even Europe, were doing fairly badly. And Japan, of course, was the wild card with Abenomics. During that period, it was a very good time because the increase in money was continuing to suppress volatility and the data were suggesting recovery. Now we're moving into a regime where the Fed, instead of suppressing volatility by continuing both the action and the discussion of QE, has shifted to a mode, whether by design or by accident, I think it's at least partly by design, where it's no longer actively, aggressively suppressing volatility. Yeah. So I think all of those things you suggest, U.S. outperformance versus the rest of the world, that is going to continue. But I think we have to recognize it's going to continue with a lot more volatility. So in terms of asset classes, I would say the shift will be from everything going up basically to risky assets going up and quote unquote risk-free assets underperforming within the United States, and risky assets and maybe even quote unquote risk-free assets in the rest of the world underperforming the U.S.
All right, Arnab, thanks a lot for your quick take. That's, of course, the global opinion. Let's take a short